Welcome to the deep dive. So if you've ever had that vague feeling that you should be saving for the future, but you haven't quite nailed down what that future actually looks like, well, this deep dive is for you.
Right.
We are moving past all that wishful thinking and really drilling down into the mechanics of strategic investing.
That's exactly it. Our mission today is to build a foundational framework. We're extracting the essential blueprint from the sources you provided.
Okay.
And we're not just looking at what to invest in, but the really critical structure that dictates how and when you invest.
And it all comes down to two main levers, right?
Two major levers.
Yeah.
Time constraints and risk tolerance.
Yeah.
If we don't define those first, every investment decision after that is just a guess.
So let's start at the very beginning then. The true building block, which the sources really emphasize, is articulation. It's absolutely critical for an investor to be able to, articulate their objectives to their agent or advisor, this purpose, this why, and the time constraint that's always attached to it. Always.
That forms the basis of all the decisions that come later. It's like the mission statement for your money.
And that mission statement, it needs a timeline. It absolutely has to have one because time changes everything about strategy. We basically categorize objectives into 3 time buckets.
The first one being short term.
Short term. Yeah, that's anything you need to do in, say, 3 years or less. This is where you might be saving for a big family holiday next year.
Or a new appliance or something.
Exactly. Or maybe an unexpected repair fund. Because the turnaround is so fast, capital preservation is it's key. You need low volatility.
Right. You can't afford to see a 20% drop 6 months before you need the cash.
Precisely. Then we move into the medium term, which is generally defined as between 3 and 10 years.
Okay.
This is really the sweet spot for things like saving for a new car or, more commonly, gathering that down payment for a first home, maybe 5 to 8 years out.
A little more room for risk there.
A little more, but you're still keeping a very close eye on the clock.
And finally, the big one. Long term. That's anything 10 years or more. And this bucket is, it's almost entirely dominated by retirement savings. For a lot of people, that means decades of growth potential.
Which means you can handle the ups and downs.
Because the time horizon is so distant, you have the greatest capacity to withstand and recover from market turbulence, which naturally allows for more aggressive investment strategies.
And it's important to talk about how the sources distinguish between individual goals and, say, group objectives, like in a pension plan.
Right.
As an individual, your objective is intensely personal, your down payment, your retirement. But for a group plan, like a registered pension plan, the objective kind of shifts.
It does. The primary focus of the administrator, who's usually the employer, isn't just funding every single employee's retirement. Their strategic goal is using that benefit, the RPP, as a tool.
A tool for what?
To attract and retain quality employees. The plan serves the goal of the administrator, which is, at the end of the day, workforce management, not just the financial needs of one person.
Wait, let me stop you there. Doesn't that sound a little cynical? Why would an employer care about an employee's retirement beyond, the optics?
It's not cynical, it's strategic. Offering robust retirement benefits, it signals stability and long-term commitment. It becomes a vital competitive advantage, especially for attracting highly skilled talent who are looking beyond just a salary. So knowing that context, that the administrator's goal is retention, that changes how the plan is structured.
That's a great insight. Okay, so if we've defined the objective, the why, and the when, how do we move it from like a fuzzy concept to something that actually motivates you?
We turn it into a financial goal. And this is a really crucial distinction the material makes.
Okay, so objective versus goal.
Exactly. The objective is retirement at age 60. The financial goal is the measurable dollar figure, the how much. For example, I need to have $800,000 saved in my RRSP by age 60.
That specific number.
That number, it provides a measurable target, and as the sources point out, measurable targets are powerful motivators.
That makes perfect sense.
No.
Once you have that number, you can just reverse engineer what you need to save every month. Now, to help people reach these goals, we use these specialized tools. Registered plans. Let's look at the overview of how these work because they all share one key thing. They're registered with the Canada Revenue Agency to give you tax advantages for specific life goals.
Right, and we can focus on, say, 4 main types that cover the most common goals. First, for retirement, we have the Registered Retirement Savings Plan, the RRSP.
And its partner, the RRIF.
And its necessary partner when you retire, the Registered Retirement Income Fund, or RRIF. Their purpose is simple: retirement.
And for other big life stages.
Exactly. We have the Registered Education Savings Plan, the RESP, which is strictly for post-secondary education costs. And then there's the newer, very popular tool, the First Home Savings Account.
The FHSA.
The FHSA, yeah, designed for tax advantages when you're buying a first home. And finally, the flexible one, the Tax-Free Savings Account, the TFSA.
And that one lets investment growth be entirely tax-free for any purpose.
Any purpose at all.
That's a great overview of the wrappers. But here's the key concept from the sources that really changes how you think about them. The plan itself, the RSP, the TFSA, it's just a shell, a basket, or a shopping bag.
That analogy is everything. We hear people say, oh, I invested in a TFSA, but that's, well, it's technically incorrect.
Right.
They invested using a TFSA. The bag is just a container, designed for tax purposes.
So the mistake is thinking the bag itself does the work.
Yes. The bag is empty until you decide what to put inside it. The performance, the growth, the costs, all of that is determined by the contents of the bag, the actual investments.
So are you holding a GIC or buying mutual funds?
Are you buying a guaranteed investment certificate, a GIC, or units of a mutual fund, ETFs, specific stocks and bonds? What's in the basket?
So a TFSA stuffed with cash is going to have a completely different performance profile than an RSP that's full of, say, high-growth tech stocks.
Completely different, even though they're both registered plans. It's not the government's registration that creates wealth. It's your investment choices inside that basket.
And that applies to non-registered plans, too.
Absolutely. The same principle. Non-registered plans are just standard investment accounts. They offer maximum flexibility, no contribution limits, no specific goal required, but every single dollar of return has to be reported to the CRA for tax.
Okay, that's a great foundation. We've quantified the goal, we've picked the right basket. Now let's pivot and look closer at that second critical lever, time. We define the objective's time frame, short, medium, long, but the sources introduce this concept of the time horizon, which is much more precise.
The time horizon is the defined future event when that invested money will be needed. And what's fascinating here is that the sources treat it as two-pronged.
Two-pronged? How so?
It includes the actual date of the event, let's say the day you retire, and an approximation of the number of years you'll need income after that.
I never considered that second part. Why is the duration of need as important as the start date?
Because it fundamentally dictates your risk tolerance during your retirement.
Oh, right.
If you retire at 65 but expect to live to 85, you need your capital to keep working for another 20 years. You can't just cash it all out on day one.
So the investments have to be structured to keep growing, even while you're drawing an income from them.
Exactly. You can't just shift everything to cash.
That really personalizes it. I mean, you could have multiple unique time horizons just within your retirement.
That's the beauty of it. And this leads directly to the core relationship between time and risk. The longer your time horizon, the more risk you can afford to take.
Because you have more time to recover.
You have the ability to invest more aggressively because you have time to recover from the inevitable volatility, the losses that happen over decades. Time is your shield against short-term pain.
Okay, so if aggressive, volatile growth investments are on one end of the spectrum for the long-term investor, what's on the opposite side? The low-risk choice.
That's where guaranteed investments come in. Things like GICs or certain annuity contracts.
Guaranteed.
As the name implies, yeah. They guarantee to pay back some or all of the principal you invested, sometimes with a specified return. They are the definition of safety. Great peace of mind.
But there's a trade-off, right? Low risk means low return.
Absolutely. Safety costs you in potential upside. But for some people, that safety is mandatory. It's ideal for people with predetermined, rigid obligations.
Like tuition.
Like tuition that has to be paid exactly 1 year from now, or a big tax bill. And they are often the preferred, even necessary, choice for those who are nearing or already in retirement.
Why is safety so critical for that specific group, the near retirees?
Because their ability to regenerate lost principal through a job has ended, or it's severely restricted.
Right.
If a 30-year-old loses 20% of their portfolio, they have 35 years of work income to pour back in and recover. If a 70-year-old loses 20%, they might not have any way to recover that capital.
And that could jeopardize their entire retirement.
Potentially. They simply cannot afford the losses.
And bringing in the math, this whole time horizon concept is tied directly to the time value of money, right? Present and future value.
Let's use the sources example to make this really concrete. Imagine someone named Martin gets a $200,000 inheritance today.
Okay.
His time horizon to retirement is exactly 7 years. He doesn't need to touch it until then. And if Martin assumes a pretty conservative, safe return of, say, 4% a year.
Which is pretty reasonable for a low-risk portfolio over 7 years.
Exactly. So using the future value calculation, that's $200,000 multiplied by 1 plus 0.04 to the power of 7, that initial $200,000 will be worth $263,186.
Wow.
By the time he retires. This isn't complex math. It's just the power of compounding working over a defined time horizon. It reinforces that idea that time is your greatest asset.
$63,000 generated just by letting time and a modest interest rate do the work. It really makes you see the opportunity cost of just letting money sit there. Okay, so let's connect this risk spectrum to the final piece. And here's where it gets really interesting. The tax advantage ladder, returns are always the goal. But how the government taxes those returns creates this clear hierarchy.
That's the core idea of strategic investing. You want to maximize your returns while minimizing how much tax eats away at them.
Right.
And the government helps us structure this by classifying investment returns into 3 distinct categories for tax. And they're tiered according to how risky the underlying investment tends to be.
Let's start with the one that gets hit the hardest, the most penalized.
That would be interest income. This is income from safe investments, bank accounts, bonds, GICs. This income is taxed at the highest possible rate.
The same as your job.
The exact same rate as the income you earn from working. Your full marginal tax rate applies. There are effectively no tax advantages. And this also includes foreign income, by the way, even foreign dividends.
So the safest investments, the ones people rely on for short-term needs, they get hit with the biggest tax bill. It's almost a disincentive for pure safety.
It is, which brings us down to the second rung on the ladder, dividends.
Okay.
These are profits paid out, usually quarterly, by qualifying Canadian companies to their shareholders. And dividends are taxed at a lower rate than interest income because of something called the dividend tax credit.
So how does that credit work?
Well, essentially, the tax credit acknowledges that the company has already paid corporate tax on those profits before they're distributed to you. So to avoid what's called double taxation, the tax applied to your dividend is reduced. It's still taxed, but it's a definite advantage over simple interest.
And finally, the ultimate prize on the tax ladder.
That is capital gains. This is the lowest rate of investment taxation, and it's really designed to incentivize risk-taking in the economy.
So a capital gain happens when you sell something for more than you paid for it.
Exactly. When you sell a capital property like a stock or an ETF or real estate for more than its adjusted cost base, or ACB.
And the ACB, what is that in, simple terms?
The adjusted cost base is basically your total cost of buying and maintaining that asset. So if you buy a stock for $10 and sell it for $15, you have a $5 gain.
Okay.
And the major advantage here is that only 50% of that $5 gain is taxed at your marginal rate. The other 50% is completely tax-free.
Wow. Okay, so a $10,000 gain from interest might leave you with, what, $6,000 after tax. But a $10,000 capital gain might leave you with $8,000. That's a massive difference.
It's huge. And this confirms that double benefit the sources highlight. The investments that inherently carry the most risk-like equities, they tend to generate the most capital gains.
Yeah.
So you get the potential for a higher return and these preferential tax advantages. It's the government's reward for accepting volatility.
I never realized the tax system was so explicitly linked to risk tolerance. It really encourages you to move beyond GICs if you have the time.
It does. And the benefits continue, even if you guess wrong. If an investor has a capital loss,
Meaning they sell for less than they paid?
they sell an asset for less than their adjusted cost base?
Yep.
Yes, 50% of that capital loss can be used to offset taxable capital gains on other investments.
So it's not just a break on the money you make, it's a way to mitigate the liability on money you lose. That's smart.
It is, but there's a specific rule for how you apply those losses. First, the loss has to be used against capital gains in the year it happened.
Okay.
But if you have a bad year and you don't have enough gains to offset, the capital loss can be carried back up to 3 previous years to reclaim taxes you already paid on gains then. Or you can carry it forward indefinitely into any future year. It ensures that tax advantage is always maximized.
So what does this all mean? We've basically walked through the entire investment life cycle. We started by defining the emotional why, the objective, quantified the financial how much, the goal, and then tied it all together with the ticking clock, the time horizon, which dictates risk, and ultimately how the government taxes the money you make.
The final synthesis is that strategic investing isn't about guessing the next hot stock. It's about a logical chain of decisions. You have to know your objectives and quantify them. That goal locks you into a time horizon, which dictates your risk exposure. And understanding that risk is key to maximizing your after-tax returns. It all flows from that initial conversation.
That structural understanding is what separates an informed investor from someone who is just, saving haphazardly. And finally, a provocative thought for you to chew on. The sources stress that financial goals are powerful motivators. So if you have multiple time horizons, say, for a car in 4 years and retirement in 20, how does quantifying the exact dollar figure for each one change your investing behavior right now? Does that $10,000 car fund goal suddenly feel like a mandatory commitment you can't push off, maybe forcing you to prioritize it over your long-term retirement goal for a while? That shift from optional saving to mandatory commitment is where the rubber meets the road.